And good evening. This is the Eye of the Storm podcast with the big picture technical view of the U.S. Treasury market. Tonight, I'll take a look at the 30-year bond, the 10-year note, 5-year note, and update also the 2-year note. I'm going to begin here with the 30-year bond. And it's been a little bit of time since I've made a podcast going over the bigger picture. So the markets remain in process of putting in the initial 5 waves down off of the high for bond price, the low for rates. And that all took place. I think technically we could likely say that the bond price hit its high in March of 2020. But it was an anomaly. It was a one-time shot up, and then it shot down, and then we proceeded to go and put an additional move up, reaching the secondary high, or what I'm calling the more orthodox high, for the 30-year bond on in July, the end of July of 2020, and that was at 182.26. And at that time, the yield for the 30-year bond was 1.17%, and incredibly low. So off of that level, we have begun to put in 5 waves down. Now, I had counted this as a primary move, or a primary 5th wave ending at those highs in 2020. And so we've begun what I'm considering an intermediate degree leg down. And it's going to take quite some time for it to get there, because even if I come out here to my max, I'm actually only going back to 1996, to May of 1996. And of course, we can collect bond information way beyond that. We know that in 1981, the yield in this bond was, I think, 16 or 18, maybe even higher percent during the term of Paul Volcker as the Fed chief. Now, what it is beginning to show me is that the market is actually having as much difficulty as the rest of us in trying to determine, are we reaching a plateau? Are we reaching a level where we might see a bounce in bond prices, a decline in the yields, and then the beginning phase of the next stronger leg down? And if I'm counting this as a minor degree 5 waves down, I'm going to believe that that is completing an intermediate degree A wave. And this whole thing is corrective. And so if I'm counting in that respect, then I'm going to be looking for a B wave, intermediate degree or not, but a B wave counter trend, rally in bond price, decline in the yield. So with that in mind, I'm fairly comfortable with that we've completed minor waves 1, 2, 3, and 4. So even if I bring this immediately down to, well, let me go one more. I made a couple of different, I guess it didn't save it. I thought I had made a 5-year. And let me just put that on so that I can, or 4 years actually would do the trick. 4 years so I can see the entire thing down. So pretty clean, minor 1, 2, 3, and within 3, a perfect 5. And that really covered the bulk of what we saw take place from August of 2021 down to that low in October of 2022. So wave 3 of this whole move took pretty much about a year and a couple of months to unfold. And then we put in a minor 4th wave, and that took us from those October lows up to the April highs in the bond. And now we're putting in a minor 5th wave down. So what can we kind of say within that? It's not been an easy count. It's been a really, I think of all of the Treasury markets, the 30-year bond has really had the greatest volatility in terms of the futures moves that I've seen out of all of the ones that I cover. And there have been days where the 30-year bond is just moving 0.2, 3 points at a clip within a single session. And that's quite the feat. As someone who's been trading in these markets since 1979, particularly here in the 30-year bond, it was a solid, huge bid, huge offer, and maybe you got 3, 4, 5, 6 tick ranges per day. And now we're seeing where these markets can move 2, 3 points in a day. So that volatility increase has really kind of not necessarily matched yields, but just really gets moved around as the market, transacts. Now, here we are within this minor fifth wave down, and I'm going to bring it, just going to keep walking it down so that we can start to see how this is all forming. Now, granted that I've already got my levels for my fib levels for a minor fifth wave down. Now, again, as we know, we're going to compare wave 5 to wave 1. So in this case, we were comparing minor wave 5 to minor wave 1. And so what the first relationship that is most common is that wave 5 will be equal to wave 1, or as I call it, equality. So it is that first Fibonacci of equality. And that level happens to be 104.11 in the 30-year bond future. And right now we're working this against the September contract, which will likely begin to roll out pretty quickly. As we get to the end of August and we start moving into the beginning of September, we're likely going to see the contract roll, and it'll go out to the October contract, which again will put a little bit of a twist on the charts, but just on the pricing. So in any case, what will be inside of minor wave 5 are going to be 5 waves of minute degree, of which, to the best of my ability, I'm kind of putting it out there as, at least on my daily, we have a minute wave 1, 2, 3, and 4, and we're inside that minute fifth wave. Now, this is where it also, I believe, starts to get sticky, because this internal count in the minute degree has had its shifts and been moved around in all the different ways. There is one count where I can put that minute wave 1 down here. In fact, it could be like 1, 2, 3, 4, and a 5. I'm not real happy about all this is, so I consistently kind of shifted around and am more comfortable with it being minute 1, 2, 3, and 4, as I've got it labeled out right now, with that third wave being, again, the longest and pretty much the strongest. But it's been these periods of indecision within the market and within the Fed of trying to wait to see what is the Fed going to do, where do we stand in inflation, how is all of this really figuring in, what, et cetera, et cetera, et cetera. And there's been narratives, there's been all kinds of things that have pushed and shoved. But the bottom line being is that the market continued to signal that we had additional downside to do. At the time, wave 5 should break the low of wave 3, which, according to the contract we're trading, is at 118.12. That has now been achieved, with the low thus far being 117.18, again, basis the current contract. So in that respect, it's done. But again, each time I bring this down, and I'll drop it down to the 4-hour, because now we're going to go inside of these and try to determine what's really going on. So again, minute 1, 2, 3, 4, and now we're coming into this decline. And this is where the volatility really hit. Very, very strong volatility. And this was during, actually, we saw into the end of July coming into August, and then again in mid-August, so just most recent. as all of the refunding took place and the rebalancing of all of these, the futures markets, all of those contracts being melded in and added in and rebalanced, really caused a lot of gyrations and moves. Now, that all gets factored into the count as well. So I've kind of walked through and felt that I have Minuet. So we're into a Minuet degree to put in Minuet Wave 5. And it can be very, again, questionable as to where do we sit within this larger move. Because if I am leaving it the way it is, I've got 1, 2, and again, this is our 4-hour chart. So I can push this open and we can take a look, a 1, 2, and then a 1, 2, 3, 4, 5. Wave 3, ABC, or is it? Or is it an AB and then we get a 5 wave? So it's an ABC. Or as some have said, and again, this is when I would likely go down to the 1-hour chart. So again, I got the 3, and then you can see it's an A, it's a B, and then it's a C wave up. So it's an A, B, C, and then I put the 4 there. Now we're driving lower in what should be a finishing 5th wave to finish not only Minuet Wave 5, but then in turn Minute Wave 5, and in turn Minor Wave 5, and once again one up intermediate A. So we are finishing up a more of a little bit longer term low. We're putting in a little bit of a longer, mid to longer term, depending on your definition. But I would think that it's taken us 2 years plus to get down here. Likely 2.5, maybe 3 years to get down to the levels we're at. If we're looking for a counter trend rally in the bond price, should that then roll out over the next 3 years, or should that be a lot quicker, maybe be a year and a half? Again, now what needs to be rolled around all of that is that the economic conditions, everything within what sits inside of what moves interest rates, needs to kind of smooth itself out a little bit, the pressure needs to be off of the Fed, number one, having to raise the interest rates, the monetary system being able to just start to smooth itself out in terms of the flow of money supply, et cetera, et cetera. So all of the different variables that we look at just to get a gauge on economic growth, on all of the different factors that are going to go into where do we sit in all of this? Where do we sit within this cycle of inflation? Now, we just heard on yesterday, on Friday, that we had Chairman Powell give his Jackson Hole speech, and it really was interpreted as more hawkish. That he made it pretty clear that inflation is still problematic, that inflation is still not necessarily under control, although they're not totally disappointed in how things have been going thus far, but they know that their job is not over. So again, trying to appease both sides of this conversation can prevent actually just laying it out the way it is. That inflation, in depending on where you live in the country, it's not under control. It's really a tight game right now. And so what does that suggest? As Powell said, it suggests that we are going to begin or continue to see interest rates go up. So we already know right now that they're working on 5.25, 5.5. Are we going to move 5.5 to 5 3/4? Are we going to move 5.5 to 6? Depending on the severity, depending on how quick they now want to jump out in front of this train, so to speak, called inflation. And we're seeing some really damage being done in a lot of different markets, one being mortgage rates. They're continuing to climb. We are seeing some danger signals coming in when we see the consumer debt, consumer credit is increasing. So whether people have the money or don't have the money, they're using credit cards to purchase. Now, what is that a signal of? Is that a signal of a healthy economy or an economy that is beginning to teeter a little bit? So how you want to interpret it, how you want to look at it, I guess that's up to each as individuals. But the market itself, I continue to view as it has decent rallies, but it really is succumbing and falling. Like just to show you, I'm just going to open this up. This is the Jackson Hole speech. So the bond market went from 120.08, dropped down to 119.05, and then they rallied it right back. And whatever, it did. But the reality is, oh, inflation's not under control. Inflation isn't really getting to the point that the Fed can relax, that the Fed may even pause. So what took place after, I think more important, was the initial reaction. So I think that there's continuing to be this downside pressure. So when I start to look at, well, what can we be doing and what is this then? Are we inside this fifth wave? Did we just complete a wave 3 inside of this? And now we're going to get this is a wave 4. And now we're going to start to work our way lower again with this huge anomaly in the middle of it. What was that, a 1 and a 2? And then we're just starting to, 1 and 2 again, and now we're going to start to drop off. And these are the signals that I am trying to read and put in. Now, one thing that I will add to this, we can go over and we can look at the 30-year yield. And we look at it as it's also a futures market. Now I'm going to flip it to the line chart because that is much more clear. So here, that 3 would actually come over to here. But let's pull it out. Let's look at the 4-hour chart. We're going to put that together, right? So we had this beautiful triangle pattern for minor wave 4. So it's a minor wave 4, low in the rate. It was a high in the bond price. Then we start to climb again. We had wave 1, 2, 3, 4, and it's this wave 5 that we're seeing this extreme volatility. Now, if anything, it's 1, 2, and this third is going to pop and be up here. I mean, that might even come in here. And what that then would tell us is that what my initial indications are is not actually, it's going to be exceeded, I should say. So what I've now put in to all of this for our yield is we've got for Minuet Wave 5, and then because I can pretty much look at this and say, okay, what we have here is Minuet Wave 4. And we're beginning to come off of that. So again, upside pressure on rates. Powell put it there. Powell told us. So the next meeting is the September meeting. And that's the one where the narrative a month ago, or maybe a month and a half ago, was Fed's going to pause, Fed's going to pause, Fed's going to pause. If they didn't bother to listen to what this guy said and the other Fed governors and presidents from around the country, some were being a little bit more dovish, but then again, maybe that's just what they do. But I think the majority were basically telling us our job isn't over yet. Inflation is not tamed yet. It is still threatening things. And we begin to see some cracks and things within our banking system. And also, we also cannot, when we're talking interest rates and we're talking our bond markets, we can't just keep it just into our little window called the United States. Mainly because the majority of the US debt is held by foreign companies, foreign governments, foreign countries. China, the European zone, the UK, Germany, Japan hold large amounts of US debt. And with inflationary pressure, we already know that China, because their economy has become extremely dangerous in terms of just falling completely apart. But yet, are we really paying attention to that? How it could or may not affect the United States? What is the global effect? So again, if we just take a look at interest rates sit at the top, interest rates sit at the top of this pecking order. And I believe on an international level, they sit at the top. Interest rates in China, that is what you can either get if you're lending or you have to pay if you're borrowing. So it can absolutely choke off an economy and a growth in a heartbeat. And it can do it here, and it can do it in China, it can do it in Europe. It can do it wherever interest rates sit at the top. So here's what I think really sits into the background of all of this. How healthy is our economy? How healthy is the future of our economy? How much of a narrative is being spun just so that we can get through? Again, within reality, I'm now beginning to broaden my view in terms of that I was looking for a particular level and possibly completing this minor fifth wave. And again, I'll just zip back to the futures market. And I felt that this, I need to open that. Nope, I need to just go up to my daily chart. That this, see, again, we exceeded the low of Minuet Wave 3. So, okay, great. We're coming down in a Minuet fifth. We're coming down in a Minuet fifth. But is this really 3, or is this 3 and this is 4? A couple of things. There's several ways to interpret how this is playing out. Is this 1 and this is 2 and this is the start of 3? So what are, again, I look at what are my fibs? What can the fibs tell me? Well, if the first one is that equality, you're looking at 104, not 115, not 117.8 or 117.21. You're looking for a whole lot more to the downside on equality. Second most common, though, as I have been saying, is 0.618. So it all will depend on structure. So again, this does remain in my picture, but are we done here, or are we going to turn and make another quick drop? Or are they going to try to rally it? I mean, it's, again, everything is kind of out there and determined on what the market is intending, what starts to come in. So, but I'm thinking that we're continue to see downside pressure. I just feel that is what is coming in here. So minimally 115.25. Now I've got to let more market continue. I've got to have more trading continue before I can really finalize any type of account. So I know that we're in that minor fifth wave, but the exact count within it is starting. It gets cloudy, it clears, it clouds, and it clears as we get more data, more information about what's to come. If we really begin to turn strongly lower, which again, the 5 and the 10 are leaning more in that direction than the 30. The 30 will likely lead the way and play a little bit of catch up. So what are our levels? And this is a big picture, okay? Our first is going to be equality, which is 104. Failure of that brings into the second most common, which is 618, which is 115.25. The third is 1.618, and that's at 85.26. Now, I'm not necessarily, as I've said before, looking for that out of intermediate wave A, as much as I may be looking for that on an intermediate wave C, which would also be down in bond price. So one more look at the 30-year yield. And really what we're looking at is 4.55. I need to put one more in here. I need to add that one. And that's what I needed to do. And so what we have here is 4.67. So for yield, for the rate on the 30-year, I'm kind of looking at 4.55 to 4.67. Right now, we've kind of topped out just above 4.44. So I think we got 4.447, almost 4.5. So, but then we still have resistance at 4.5, and then 4.55, and then 4. So here's 4 5/8 essentially. And there are additional levels. You could just think about 4 7/8. It can work its way right up to 5, and still be within the realm of reality. Okay, over in the 10-year note, it's the same picture. And again, a little bit different, I'm going to show you. So here in the futures market, it's Minuet Wave 1 is at that July low, and Minuet Wave 2 at that mid-July high. So we're working our way on a minute third wave. That in and of itself tells us that the 10-year has got a lot of additional downside, even though we're clearly below the minor third wave. So under this particular count, we're looking at a 10-year that can, even if we're looking to see where Minuet Wave 5, if we're in that, or Minuet Wave 5 to complete Minuet Wave 3, we're looking at 107. We're looking at 105 on the futures market, 108.45. And our low thus far has remained just below 109. So we've gotten under 108.28. So it can get really it can get very volatile. Now, at best, folks, 1, 2, and this is 1, 2, 3, 4, 5 of the 3 finishing up here, and this is 4, and then we still got a larger 5 to come. So there's a lot. The story seems to be just a little bit clearer over in the yield. So there's our minor 4, and that was in the April low here. And then we have minute 1, 2, 3, 4. And what we're looking at is now for Minuet Wave 5. So within this Minuet Wave 5, I'm thinking we've only done Minuet 1 and 2, and we're still in the third. The market has kind of hugged right around 4.2. It's got a little bit below, almost back to 4%, but it's not dropping. As if, okay, that was it, and we're going to enter into this next, where the rate relaxes, so rates go down and bond prices go back up. This is why I sit and I kind of go, I think it's too early to call it. I think we still have upside in rates to put in, and then we get Powell's speech talking about inflation still is problematic, expect additional rate hikes. And he didn't say a rate hike. It was plural, rate hikes. Now we know that they spoke of 2 more for 2023. So we should expect at least 1 more. And now I'm thinking, instead of saying they're going to pause in September, I think it should be that they're going to raise in September. And then we still have the potential of an additional in October. So lots can still happen here. So if I'm looking here, and we're just looking at a minor, I actually can't get back far enough in terms of yield to get minor wave 1. So unfortunately, I can't put that one in here. But I can give us a Minuet Wave 5 as it compares to Minuet Wave 1. And in that respect, I have right now, we've topped out at 4.34, almost 4.35. And that exceeded the high for the minor third, and that was back in October of 2022. But above that, we have 4.5, so 4.543. And then the next level up is 4.864. And I can go one more. And let me just because we're having this conversation, I am going to put that in, and I'm going to call this 4.236, which is our next fib to the upside as all of this progresses. And that sits at 5%. Because I wanted to make sure that it's like, that is not out of the realm of reality for the 10-year note, for the 10-year note to be hitting 5%. It's in the picture. Okay, moving along. And by the way, all of our moving averages are very in agreement of rates still going higher. Over in the 5-year note, also been very, very interesting. And I'm going to keep this pretty much on the line chart, which is on a closing basis. If I just kind of shift it around, the candle can make it very unclear with a lot of the tails that we have all over the place. When I put it on the closing basis, you can see things much clearer as to what is taking place. So here in the 5-year note, again, there's the minor 4. That's the high, minor 4 high. We're looking for a minor wave 5 down. Again, the market has broken very nicely below the October low, and it's also broken below the July lows. So, and I think there's more to come. See how it was left? Now this is again is this is the daily picture for Friday. It didn't go up. And went down. 30 did a nice rally after that. The 5 did not. So the 2, the 5, the 10, they did not. So again, it's all pricing. It's how everything gets balanced between all of them. But here we have Minuet 1, 2, 3, and 4 went in Minuet Wave 5. The best I can count this, folks, is 1, 2, 3, 4, 5, Minuet 1, ABC Minuet 2, kaboom, kaboom. Is this 3 and this is 4? I don't know. I'm leaving it open. Because if I measure this out, they have to fit in terms of wave 3 can't be the shortest wave. So that's why I'm going to let this play out a little bit more just before I put a 3 in. But there is additional downside. So what I can do, and I have put in, is for Minuet Wave 5. So if we take a look at that, 100%, which is the equality, is 104.147. 1.618 is 102.080. And fix that, put the right color on it. And get it all set up, and then I get the color wrong. Okay, we're going to put that there. And 2.618 is subpar. Par, when you're talking about a bond, that's 100. Par is 100 pricing. This would be subpar. So 1.618 is 102.080, and then if it breaks, look out below. We got 98. So this is talking some serious stuff for the 5-year and for the short end of the curve. So it would really start to say something very dramatic is happening within the economy and with the dollar and with a lot of stuff. So again, we're going to keep our eyes and just keep things in perspective. Okay, so that is the 5-year. And lastly, I want to come down to the 2-year note. And the 2-year note is also, I get it up there and I forget to put my colors on. And I'll try to put the 618 all in the same color. Here we are. There is minor wave 4. And this is, and see, actually, I'll show you why I do it on the closing basis. This was kind of just pretty ugly. That 1 actually belongs way up here. Let's just change that around and stick it where it belongs. And I could put the 2 there. And let me do that because I think that's how I was doing it. And then it breaks down 1, 2, 3, 4, 5, and this is wave 3. I don't want to end the drawing. I want to, sorry, let me try do this differently. Put this over and, oh, come on. Sorry, folks. Okay. Hourly, daily. Put the 3 where it belongs. There, and the 4 goes over here. That'll shift again, but I just need to kind of clean it up. So with this in mind, we're inside that minute fifth, and look, 1, 2, still in a third. Minute 5, when compared to Minuet Wave 1, equality is 100.192. Now, the 2-year note has just retaken or rebroke below 101.065, which it held forever. And now it's just basically coming in to start. It only equaled, and finally on Friday, it actually started to break below the July low, which was an anomaly sort of, because it spiked and it came right back and they put in a big rally. Whereas now, no, we're starting to move it lower. So the yield curve, the curve getting more inverted. So we have 100.192, that's equality. 1.608 is 99.200. And then 2.618 is 98.015. So again, when I start to look at the 2 and the 5, they look like they got a lot more punch to the downside to do. And here as well, I can look at that 2-year micro, and we got looking at the same noise. And let me just do this. In here, I got to get rid of these extremes that we've seen. So here again, we're teetering, or we just slipped above. 2-year note just moved above 5% on Friday. What's next up? See, if I'm looking at this, that minute 5, it was holding equality above, below, and now it just broke above. And that kind of gives us up to this next one, 5.213, 5.6 or 5.7. Now, in this one, because it can get a lot more active and a lot bigger pushes, I'm going to put the rest in, and so that we can see them. And I did, by the way, thank you all for putting in and just making it save as a default. I have, but I'm now just kind of changing it around a little bit. So that's 2.6. 3.618 is 6%, just over 6%. So again, these are within the realm of reality. We have a Fed that's not giving us any hints. It's like, yeah, we're really pleased. We like it. And we think that we're going to be able to start to slow down. No, they're beginning to say inflation's not under control. And remember, they're the ones that are going to go meeting to meeting, and depending on the data. Oh, I guess the data is not telling them what they really need to see. And we need to keep all of this in mind. So that's my technical picture for the Treasury markets. And bottom line here, folks, I still think we got higher rates coming. And the rate markets and the futures markets are all showing that and have been. And now it just is being backed up by the Fed itself. Thanks a lot for listening, and thanks for watching. And hopefully I'll be able to do another one in about a week.